As we kick off segment 3, we wanted to show this slide again just because it's important to appreciate where manufacturing PMI is, and it's slowing everywhere, not just in the U.S. This is looking at U.S. drops, but there's a lot of comparisons to the rest of the world when you look at their manufacturing shrinking, especially given the amount that a lot of the emerging markets and other areas rely on diesel and distillate in relation to their manufacturing. So we do see a fairly sizable drop in terms of where things are, where that's going to continue. But as that happens, you really have to consider when you start looking at the OPEC data, when they talk about those 100 million barrels, you have to factor in NGLs. And as we've been saying, for anybody that has known me for a meaningful period of time or been listening to us, we are bullish NGLs. Long term, obviously, there's short-term issues with petrochemical demand coming down. But long term, you need more plastics. You need more things like that, especially if you believe into the ESG boom. A lot of plastic goes into it. A lot of these pieces have to be made, and it's coming from the NGL side. So as you have new facilities turning on, even as utilization rates stay reduced across the board, you just have more demand inherently with the activation of these new units, which is going to keep a fairly sizable number. And as distillate and especially light distillate, or I should say ultra low sulfur diesel, very low sulfur diesel, as those prices remain elevated, well, is propane propane can replace some of these engines. Do I have more access to propane than diesel? Is it price competitive? And those are things that are going to, really provide some of these tailwinds for the demand numbers. It will be less driven by black oil and more driven by liquids. And that's some of the pivots that we like to talk about when we're looking at world oil demand. So you can see that they've taken down some of their demand estimates as we closed out 2022. But as we've been saying, we thought they were a bit overstated anyway. It's just a matter of a lot of this, as we've been showing with where natural gas liquids, especially LPG, you've seen a sizable increase around the board, and that has been a big driver of where things are in general. Now, when we look at world oil demand in 2023, you can see that the estimates came down a bit in Q2 and Q3, but 100,000 barrels a day in a 100.7 million barrel a day market. Rounding error. So the biggest component is going to be we're going to get a drop in demand from the level of just recession. But how much of that, so say for an example, we're like 2008 in terms of the drop. So we get a decline of 6 to 8%. So let's just say we get a decline of 6%. So instead of being at 100 million barrels a day, you're going to be at 94, but you have more NGL demand. So is it really going? So, and that's going to provide some of this staying power, and the U.S. is in a good position because as we continue to see OPEC produce well below their quotas, that's taking some of that NGL supply out of the market and keeping our NGL market in the U.S. fairly well stable. And that's something that a trend that I don't see changing. Now, we've had an increase in supply in the U.S. We've had a decrease in demand in the U.S. So pricing is also going to remain competitive, and that's going to make our exports robust. But that's the important caveat when we're looking at world oil demand. How much of it is black oil? How much of it is liquids? And what are the drivers? Because we do see softening in the black oil world, not as much, and if anything, actually an increase in the natural gas and the natural gas liquids and condensate world. So when you look at OPEC oil production based on secondary sources, we've had an increase of 91,000 barrels a day, driven by Nigeria, Libya, with small declines in Kuwait, UAE, Saudis fairly stable. So as we've been saying, it's just if OPEC was producing at their quota, crude would be $20 lower. But they're not. So that's the staying power. And as we've been saying, it's going to be a very volatile market with broad swings because what is grabbing the narrative? Right now, the narrative is being grabbed by China's reopening. You do have Lunar New Year. You do have a lot of travel right now, not as much as normal, but you still have more travel than you have. Plus the reopening, that's the narrative that demand's going to bounce. And supply is being where it is. Well, supply is shorter than it should be. So demand has a narrative. Now, as China disappoints, which we believe it will, that now you're going to have the demand decline or under appreciating. So that's going to put the downward pressure, but you still have lower supply. So instead of bouncing back and forth between, let's call it 50 and 60, you're now bouncing between 80 and 90 on the Brent level because supply still remains, on a lesser end. But it's just, is supply winning that day, or the narrative of the day, or is demand? And right now, with China reopening, Lunar New Year, demand is in the driver's seat. But it's important to look at, well, where is demand? So travel in China recovering, but Lunar New Year travel not back to pre-pandemic levels. And through January 17th, because for many, the holiday started on Wednesday, January 18th, you can see that it is still very much below where it has been in the what quote unquote normal years. And that's something that we see continuing, and we don't see this big pile. And given there's going to be an increase in demand, our estimate is about 500,000 barrels a day. If you want to say it's 1 million, okay, it's 1 million barrels a day. But whatever they don't consume, they're going to export. And there's more than enough export quotas. So anything that gets put into the market, and there's a big amount that has been hitting the export market. So as China ramps, you're going to have other areas in Asia slow down. So there's going to be an offsetting component to demand levels. So think of it, for every 100,000 barrels a day of refining capacity that increases in China, that's going to increase underlying supply. Whatever doesn't get consumed there is going to get kicked into the international market. And it's not going to be one for one, but you're going to have to weigh the two together, because there's going to be a barbell activity between what is China exporting. We have slowing demand in the Asian markets, especially across the ASEAN, as we've showed on the ECON show, with leading indicators, manufacturing, exports. Exports have rolled over considerably, and Korea and Taiwan are very good bellwethers for global trade. So we're going to get these pressure points, which is going to limit demand in these areas. So every new barrel getting exported from China is going to put more pressure on refinery runs, and then economic run cuts are likely, given the fact that we're already sitting at a massive storage level, especially on the gasoline front, which is going to put pressure on a lot of those numbers. Now, when you start looking at China over the longer term, we've had a flip. You can see that the Chinese population shrank last year. We believe it started closer to 2020, 2021, but they'll never agree to that. But you can see births started dropping way before COVID. This is not a COVID problem. This is something that is a real pivot in the population shift. And for anybody, I worked for companies back in 2010, 2011, where we were negotiating with China, and we negotiated for 6 months, and then at the 23rd hour, they said, these are our terms, take it or leave it. And now it essentially scrapped most of this hard work and negotiation, but the company decided to sign it anyway, with the idea that we have to get access to this growing middle class, this growing market. Well, for anybody who was in the same position as myself, it never panned out. You never got, because the idea was give up margin, get volume. You never got the volume you were expecting. And now that's getting even harder. And for people who built manufacturing there, well, your workers have gotten more expensive. Now you have this longer term pivot in economic growth and these headwinds that are persisting. And you have a real estate problem. You already have hundreds of thousands of ghost cities, and you have less people to fill them with. That's going to be a long-term impact to diesel demand, to gasoline demand. And that's going to, again, not to say that they're just going to export more. So as they export more, what does that do to the rest of the market? What does that do to Asia, to the Middle East? Because those barrels and those shipments are going to reverberate backwards. And that's one of the big things that we've been talking about, and one of the things that we want to look at, especially as we, short term, when you look at Russia. So Russian diesel share in Europe is dwindling. And that's just because we're coming up on February 5th. So they took in a huge slug, and now you're going to start to see that slow down. So diesel type fuel cargoes originating from Russian ports are set to fall to about 637,000 barrels a day. The drop in Russian flows is likely to be outpaced by an increase in supplies from the Middle East and North America, which is what we expected to see. And it's funny enough, the Middle East is importing Russian barrels, whether it be crude or diesel, and then re-exporting it. India is making diesel with Russian crude and then exporting it. So again, it's still Russian made. It's just going a further distance. And this is also going to support volumes coming from the US. Now, when we look at the Middle East, you've had an increase in floating storage. And when you look at it going back through the years, 2016 and 2017 were obviously above where we are, but we're starting at a very high level, and we don't see that improving. Given the competitiveness of Russian crude in Asia, why are you buying Middle Eastern? Given the fact that Europe has seen some slowing demand, you have strikes, you have some slowdowns in refinery runs. You've had an increase in CPC, you've had an increase in Libya, you've had an increase in the U.S. That, again, is going to limit where Middle East is able to send crude. And we expect to see actually some additional softness in differentials as we progress, not only through January, but more into Feb. So when we look at the U.S., as we've been saying, it's going to balance out. 4.2 million barrels a day was too high. We're going to stay. There's a lot of staying power at that 3.8 million barrels a day. One thing that Saudi did do is they cut out the buying from Korea, Japan from the U.S. So that's going to limit some of those additional flows. But again, we're still going to see an elevated amount going from the U.S. into Europe. Dubai and first month Brent, when you look at it, again, you're seeing this softness. You're seeing some of these levels coming through, but you're going to have to see the differentials widen again in order to clear some of this glut, and we're just not seeing it. And that's, again, we expect to see differential softness. We had some near-term buying, we had some near-term strength, and in terms of buying, and that put a floor in differentials, but now we're starting to see that wane again, and it never got to the level that was hoped. You're starting to see some of that slowdown, and that's going to put a bit of pressure back into the physical market. Global crude oil on the water had a dip. A lot of that was driven from two factors. So one of them was obviously crude oil in transit. You're seeing some things go back into floating storage. You're starting to see some of these cargoes, as we said, we had a bit of a slowdown in buying. That, excuse me, that's showing up here. But then you had a bit of a pickup for February loading. So we should get a little bit of an increase in Feb. And we're as you can see here, we're still well above average. But it's just we're going to come down, then we're going to level off, and then still stay above seasonal norms, just at less of a new surprise to the upside. Floating storage, still well above where we were in 2022. We expect it to stay at the very high end, just given based on how much is in West Africa, the Middle East, and more importantly, how much remains in Asia. Now, Asia's dropped just below where we were in 2022. We expect it to stay just above. As now we're in the Lunar New Year vacation, that's going to slow down activity at the port, put more on the water, and you do have more shipments showing up. So we will get a bump, not going above to where we were in 2021, but still above where we were in 2022. China's super tanker, some of the purchases have increased, as we've been saying. So it's going to stay at a higher end because China has export quotas. They've had refreshed import quotas. So now you're going to get a bit more buying, but you haven't seen that really drive up any type of additional flows. You've seen some additional purchases from Angola, but nothing too sizable. And that's putting a lot of pressure on the market. And Russian crude is still well below market. And that's what we continue to see. India Again, the Russia took the record for the most crude imported into India, and we expect Russia to take a lot of this market share and displace some of this crude. And if Saudi maintains their elevated OSPs into the U.S., it's going to get stuck in the market, as we've seen. So when you look at Shandong, here you can see that Shandong activity had a sizable drop to 63.3%. A lot of that is driven based on the holiday. As we've been saying, we do see a sizable increase coming. It's obviously hasn't happened yet. So that's just going to put more crude in storage, going to slow down some buying. We thought buying was going to be a bit more elevated. This is going to slow it down a touch, which is because they've already had their orders. It's going to put a bit more crude in floating storage. So we will see some of that timing delay, but we do expect to see a bit more activity over the next few weeks. Even though seasonally speaking, and again, activity is going to be relative to seasonal. So we do expect to see this elevated against seasonal norms. West Africa had a sizable increase. A lot of that is Nigeria. Back to the point where you're getting a lot of this product displaced. You had some decent buying from Nigerian crews, and now you're starting to see that drop off again, and that's putting pressure on Feb. You've already had some cargoes slip in from Angola from February into March. So again, you're starting to see that slowdown, and some of those cargoes are slipping into other months. Coming to the U.S., you can see that gasoline and distillate exports remain elevated. That's going to stay the case. LPG, it dropped 298,000 barrels a day, still at record levels. That's going to remain. And then crude is right back to where we expect it to be, of close about 3.8. Could it be 3.7 to 3.9? Sure, but 3.8 is a very steady number. Here, as we've been saying, gasoline exports are going to stay at the higher end, just because they're trying to manage storage. There's a lot of gasoline in storage, trying to balance this out, because especially PADD 3 tries to target those diesel barrels, it's going to create inherently more gasoline, and you're going to try to manage that, which will keep things a bit elevated. But we do expect it to come closer to the 5-year average, but again, still remain at the strong side, where distillate is going to stay well above the 5-year average and stay closer to the top end of the range, especially as we get closer to February and more of that Russian product drops off, and Europe needs to find new product sources. When we look at crude exports, again, staying strong. When we look at LPG, here you can see back within the top of the cloud, but still staying at the strong end. It's either going to set new all-time records or seasonal records, or at least be obviously well above the 5-year average, but closer to the top end of that cloud. Now, when we look at Fujairah, reported 20.156 million barrels. It rose 317,000 barrels in storage. That pushed them back above the 20 million barrel point, and that was driven by light and middle distillate. So when we look at light distillate, there was a build of 864,000 barrels. East of Suez gasoline complex strengthened in early trading because of the expectations of Chinese January exports fell on the month. But when you start looking at some of the flows, the gasoline complex then softened during the early trading of 17 with the weakening U.S. RBOB crack. When you look at poor winter gasoline demand, and then when you look at other demand factors in Asia. So even though Chinese exports fell a bit short, demand also fell short. And now, as we see that obviously people are traveling more in China, by no means anywhere where they have been previously for Lunar New Year, as they come back into the office, you're going to see another increase of exports. So we remain bearish on light distillate, and we expect more builds in light distillate over the next few weeks. Middle distillate increased 547,000 barrels a day, coming in just over 3.3 million barrels. Backwardation east of Suez gas oil market eased as they awaited to see what is coming from China. Steady fundamentals kept the market, fairly stable. And as you get more EU sanctions, you're going to get more Russian product on the fuel oil, middle distillate, heavy disty side, heavy resid side. So it's going to be a matter of how much that displaces. We expect to see some builds, but still remain at the lower end and on the bullish side. Heavy resid dropped 1.094 million. And that spot trading activity at the bunkering hubs was less than average for the second day as we got into 17, and we're starting to see low sulfur oil cargo markets seem to take a bit of a slowdown, and we do expect to see these builds. But remember, they're going to be lumpy just in terms of what's being shipped, sent to shipping ports. But as we talked about in the ECON show, there's a lot of headwinds to that global trade. Time spreads, and Brent still remain in contango. We don't see that changing. And as we said last week and the week before, it's going to be fairly locked in right around these rates. When we look at activity, as we were saying, Angola, we saw slippage out of January into Feb, some Feb into March. And we expect to see more of that in Nigeria, especially as we see some of those conversions. Norway had that increase as Johan Phase 2 came online, and you could see the bounce in Russian Federation flows in Jan, and we expect that to get much closer to the 4 million mark as we get CPC factored in. So again, things still remain fairly stable. Libya, again, sitting at that 1 million barrel a day export number. Yeah, we don't see that changing too much. When you look at Europe, as we said last week, we expected to see builds. We got a build. We expect that to continue, especially as refining activity is hindered, and there is some of that floating storage that is going to get pushed back into the market. Now, when you look at builds, we had a sizable build in gas oil. We're above where we were in 2022. So things are getting a bit better. But remember, they're trying to stuff the market ahead of the Russian sanctions. And as that rolls through, that's going to create more lumpiness. So we should get more volatility in the number. But again, it's still at the lower end. That's still going to remain the case while gasoline continues to be at a record number. With gasoline now back above the record in 2019, it's going to support exports. They're going to try to do whatever they can with it. As we get some of the strikes hitting and some of the slowdown in refining capacity, that'll pull some of this from storage, but increase, again, oil storage. So it's just kind of a one-for-one. And then based on demand, based on exports, we expect this to remain still at all-time highs. Fuel oil, still at the very high end, above 2022 levels, based on the market and the amount of Russian product sitting in floating storage, not only or floating in the world, not only in Europe but also in Asia. Fuel oil is going to remain a problem and remain very elevated. When we look at Singapore, small drop in total weekly volumes, 45.9 to 45.4. Still well above the average. When you look at the breakdowns now, light distillate, massive build, as we've been saying, based on the flows, lack of demand. This is going to be a huge problem when you look at Asian refining cracks. Gasoline, light distillate is going to be the overhang, which is why economic run cuts are closer than people are giving it credit for, which is going to hurt oil demand, which is one of the things that we've been talking about. Middle distillate on the other side continues to be at a bullish front. So when you look at the market, middle distillate is a little bit below where we were in 2022. And that's going to be the catalyst of how strong is this to support gasoline cracks. And those are some of the different pressure points that we're going to continue to see, problems that are going to remain. And then when you have the swing of resid came down a bit, but there's a lot of Russian volume sitting out there. And as Russian diesel gets displaced out of Europe, tries to find a home in the Middle East and Singapore, you're going to have more builds. As you get more builds on the storage side, that's going to put more pressure on crack spreads and what we think is going to drive more economic run cuts and, again, reduce total oil demand. North Sea, sizable increase in floating storage. Again, that's going to pull down some of the differentials, keep some of that volume flowing into Europe. And now, as you had European drop in floating storage, increase in land storage, and we still see some sizable numbers in floating storage in Europe, slowdown in refining activity. Again, that's going to keep things a bit elevated in the European theater. So that's what we have for you today. If you have any questions, please feel free to reach out. We'd love to hear from you in the comments section on Twitter. And again, thanks for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.